So as we were saying, right, those that are anything in your appropriation account that you would have subtracted would be now, we'll find it on the what? Credit side of our current account. Right? We'll find it on the credit side of our current account. So interest on capital. Interest on capital. Remember the interest on capital as it relates to gin was what? 6,000 likewise, so wine it was also 6,000. These were calculated in your what? Appropriation account. Now there was no salary that was paid out, so no salary would be there. There was no interest on loan, there was no bonus, right? So we'll move right into our what? Share of profit. The share of profit which was also calculated in our what? Appropriation account. Now for gin, the share of profit for gin was what? 25,338, right? So it was 25,338, whereby as it relates to wine, it was 38,007. $38,007. Right? So these are all the things that would have been included. So what are we going to do now? We're going to what? Balance off our current account, right? So just as though we would have balanced off your 3-column cash flow. We'll be now balancing off the current account. Now in so balancing off the current account, right? Let's look at gin. The debit side for gin adds up to what? 6,300, right? Whereby the credit side, 15,000 plus 6,000 plus 25,338. Right, gives you a total of what? 32,838. So the credit side is greater. 32,838. Right, the credit side adds up to 32,838. So therefore, this must also equal a total of 32,838. Now when you find the difference between both sides, right? So this equaling a total of 38,838 minus 6,300, that gives you a total of what? And the minus 6,300 from there, you get what? 26,538. So the balance for gin would have fallen on the what? Debit side, which is what? 26,538. That is the balance CD we're making reference to. Now let us turn our attention to wine. On wine, the credit side, 6,000 plus 38,07, give you a total of what? $44,007, whereby the debit side gives you a total 200 plus 4,004 plus 220, that gives you a total of what? 4,820. So therefore, the credit side of wine's account, which add up to what? $44,007 is greater than the debit side, because again, the debit side had only add up to what? 4,820. Now when you find the difference, you get a total of what? 39,187. Alright, you get a total of 39,187. Now when you add it back, you get back the total, which is 44,007. Now you double line to show that you have balanced off. Can we stop there? The answer is no. Right? We know once you have a balanced CD, you must have a what? Balanced BD. Right? You must have a balanced BD, which is recorded on the opposite side. So what we're going to have right here is balance brought down. As it relates to gin, it was what? 26,538. Whereby as it relates to wine, it was 39,187. Alright, so these are the opening balance for the year 2015. So these would have been your opening balance for the year 2015. In other words, this is what the company owes gin at the end of the year, whereby wine at the end of the year. Alright? That's what the company owes. Now we're going to shift our attention to now doing the what? The balance sheet. We're going to shift our attention to now doing the balance sheet, right? So we're going to pause and then we'll move on to doing the balance sheet. Alright, we're now looking at the balance sheet, right? We're looking at the balance sheet as it relates to the question. So we're starting off with our non-current asset. Again, it's a 3-column balance sheet. So our non-current asset. Now the first non-current asset that we have is what? Land and building, right? So you see it looking at the trial balance. So land and building. Land and building there, remember the first column is what? At cost. The second column represents your what? Accumulated depreciation. The third column represents your what? NBV, net book value. Alright, so land and building at cost. Land and building at cost was what? 160,000. Was there any depreciation calculated for land and building, or was there any provision for depreciation? No. So there were no accumulated depreciation. Alright? So this would be nil. So therefore again your net book value would have equal what? 160. Next of which we had what? Equipment. Next of which we had equipment. Alright? Now equipment at cost was what? 15,000. Equipment at cost was 15,000. Now the depreciation calculated for equipment for 2014 was what? 3,000, right? The depreciation calculated for equipment for 20,000 was 3,000, right? But if you look at the question, you will realize that there was a provision for depreciation for equipment. That's a third to last in the trial balance. There's a provision for depreciation for equipment of what? 2,000. So when you add the 2,000 plus the 3,000 which is calculated for 2014, you get a total of what? 5,000. Right? So the accumulated depreciation on equipment, the 2,000 from the previous period plus the 3,000 for this year give you a total of what? 5,000. Thus subtracting your 5,000 from the 15,000 to give you a total of what? 10,000. You add this right here, you get what? 175. This gives you what? 5,000. And when you add this right here, you get what? 170,000. Alright. Now we can move into the what? Current account. Can move into our current asset, my bad. We can now move to our current asset, right? We can now move to our current asset. Now current asset we're starting out with our what? Inventory. Which of the inventory we're talking about? The closing inventory, right? Your closing inventory or what we refer to as our closing stock. Now the closing inventory or the closing stock given in the question was what? 30,000. Now next we insert our what? Debtors. Debtors otherwise known as our what? Accounts receivable. Now our debtors in the question was what? 6,000. But we'd have to make adjustment to our debtors. We'd have to make adjustment to our debtors. Reason being, there was a provision for bad debts. Right? So what do? Remember that provision for bad debts is subtracted from your debtors. So you're going to minus the provision for bad debts. Right? Now provision for bad debts, remember that provision for bad debts had increased. So it was 700 before and it was increased by what? 50. So the total amount goes to your balance sheet. Right? So it was 700 plus a 50 give you a total of what? 750. So 750 from the 6,000 give us what? 5,250. Alright? 5,250. And there was also what? A prepayment, right? So there was also a prepaid expense. There was also a prepaid expense. Which of the expense was prepaid? Advertising, right? Advertising expense was prepaid by what? 120. So that 120 is your money, right? Thus making it a current asset. Then next of which we had the what? The bank balance, right? The balance in your bank account was what? 20,000. Now when you add all of these, you get a total of what? 55,370. The total of 55,370. Next, we're going to move into our what? Current liability or liabilities. Now, in our current liabilities, we have our what? Creditors, otherwise known as your what? Accounts payable. So we have our creditors, which is otherwise known as our accounts payables. Now, our creditors was what? 9,500. Was there any expense that was accrued? Meaning that was there any expense that was owing at the end of the period? The answer is yes. Electricity, right? So you had accrued electricity. the electricity was how much? 145, right? So this is owing. This is a liability to the company. You had owed electricity of 145 at the end of the period. Alright? Now that was the only other current liability that falls for a period that is due for a period less than a year. So therefore when you add these two together, you get a total of what? 9,645. Now we're now going to what? Subtract this 9,645 from the 55,370. Right? Based on the format that we're using. Right? When you minus the 9,645 from the 55,370, you get a total of what? 45,725. Right? This is what we make reference to as our what? Working capital. Right? This is what we make reference to as our working capital. Now, when you add your working capital to your non-current asset, right? To the total of your non-current asset on the net book column, on the net book value column, which we see right here is to be what? 170. So when you add the two, you get what is known, you get what? 215,725. And this will double line right there. Now we move right into our what? The finance by section of the balance sheet. Move into the finance by section. Now in the finance by section, we're starting out with our capital. Now if you notice thus far, right, that everything that would have done thus far, it's the same thing that you would have been doing from fundamental of accounts. There's nothing new. The only changes as it relates to the partnership is that in the finance by section, right, we're going to include the current account balance, which is your closing balance. So the capital. Now again, the partners were what? Gin and wine. And both of them contributed capital of what? 30,000. Right, so their total capital contribution was $60,000. Now what about the current account? The current account, right? So you have what? Gin and wine. Now the current account balance. Bear in mind, the current account balance that is transferred to your balance sheet is the closing balance on the current account. It's the closing balance in the current account, right? That is what is transferred to your balance sheet, your closing balance. Your closing balance, right? Your balance at the end of the year. So the balance at the end of the year for gin closing balance was what? 26,538. Whereby wine's closing balance was 39,187. So the total of the current account, thus giving the total of the current account to be what? When you add these two figures to be 65,725. Alright, so when you add the total of the current account. Now in turn, we're going to know what? Add the total for the current account to the total of the capital account. Now when you add those two, you get a total of what? 125,725. That is 125,725. Can we stop there? No. Because if we notice that there was a what? There was a liability, right? Now it didn't state to us that it's a short-term liability. Right, so the assumption that we're going to take, because if it's a short-term liability, they would have to say to us that it's a liability that is due for a period less than a year. And if that was so, we would have included that liability under our current liability. But that was not stated. So there was a loan there. Right, there was a loan and the assumption that it's a long-term loan. So therefore, moving to our long-term liability, which is ahead in your balance sheet. And the long-term liability there being our loan. And that total was what? 90,000. That total there was 90,000 for loan. So when we add the 125,725 plus the 90,000, it should give us like a total of 215,725. Thus balancing our balance sheet, right? Thus balancing our balance sheet. Alright? Thus balancing our balance sheet. So therefore this there this figure, which which is known as your total asset in the balance sheet. It comes back to the balance in your finance by section of the balance sheet. Alright? Just trying to match the words and figures. Just trying to match the words and figures there. Alright, and this would pretty much concludes our lesson or concludes the working out for gin and wine, alright, tutorial. Alright, that pretty much concludes us. Alright, so enjoy the rest of the afternoon. We'll be sending other questions as it relates to the email. I suggest that you try them on your own, and if you're having any problem, you could get in touch. And I'll try to send other workings. Or if there's any other question that you'd like to work, I'll work it and then send it to the email. Alright? Thank you.